Man, what's he so excited about? It's not even football season yet.
He just closed a loan with the Mortgage Solutions. Welcome back to Money Morning. Good morning to everyone. Top of the morning to you. My name's Eric Stewart.
And I'm Paul Robinson.
We're here with Andy Bauer. He's with the Federal Reserve Bank of Richmond. And before the break, we were just talking about how consumers are in trouble and things that the Federal Reserve is doing to try to stimulate the economy, kind of get folks out of trouble and avoid the ultimate scary thing, which is recession or even depression.
Right.
I don't know which one of those words is scarier to me, but I know that we're on the brink of one of those major. What could happen if we went into recession or depression, or if we aren't already in it? What's the worst thing that could happen?
Well, generally, I mean, the worst thing that what happens is during recessions is you have massive job loss. Generally, there's certain things that happen during a recession. One is you see the unemployment rate go up. The economy is no longer producing jobs, it's losing jobs. Investment falls off, business investment falls off. Businesses don't want to invest in an environment where the economy is weak. People become more uncertain about their own personal finances. Businesses become more uncertain about their profitability in the future. So, but the worst thing is that there's dislocations in the housing markets and the labor markets, and people really feel it in their pocketbooks.
So what we've seen over the past year and a half in the mortgage industry is that, as we were talking before in the last segment, a lot of people bought at the top of the housing market. They used aggressive products, adjustable rate mortgages, with the belief that they'd be able to refinance out of them. Now everybody on Wall Street has backed out, and they're not offering the same products that were being offered a year or two ago. What has the Fed done to try to re-stimulate New York?
Back in August, this kind of really came to a head when banks and other financial institutions just didn't want to lend to one another. One of the roles of the Federal Reserve is the lender of last resort. So when banks have a hard time obtaining funds, we step in and provide those funds. And so in addition to lowering the federal funds rate to counter economic weakness, what we've done is we've started lending to banks and other financial institutions to give them that liquidity that they need so they can continue operating. Here we are at the beginning of April, and there's still a lot of pressures in the marketplace, and basically it's all tied to the housing market. As long as people are uncertain as to the quality of the mortgages, whether people are going to default on their mortgages, all the securities that were created based on these mortgages, people are going to be uncertain about the value of those. And as long as we're uncertain about the value of these securities, there's going to be uncertainty in Wall Street.
The main issue is that if the Fed has the money, why can't they dictate some of the terms of providing funds to these banks? Because there's the little guys getting hurt the worst that doesn't have the 680 credit score. You're below 680, you're pretty much, you're in trouble. And that's what I've witnessed on a day-to-day basis dealing with consumers directly.
Yeah, one of the results of there's dislocations in financial markets is that now credit is much tighter. Not only are banks not willing to lend to one another, obtaining a mortgage, obviously, as you said, is much more difficult. The Fed, our role is to provide this liquidity to the banks. Not in the business of really telling banks what they should and shouldn't do. We think that banks and other businesses, they've got better information as to what they should be doing with their funds.
Well, obviously, that's not totally a true statement, because we wouldn't be in this crisis if banks had more control over what they did with their funds. So when does the Fed say, hey, we're going to write you a check for $200 billion. We have a few rules about lending it to you?
Again, the role of the Federal Reserve in terms of the lender of last resort is just that, is to make sure that the financial system continues to operate. Although in terms of public policy, we'd really like to see more people stay in homes. We have a vested interest in the economy continuing to function and growing strongly. But really that would be outside the scope of our mandate, really. We were enacted by Congress, and we have certain guidelines in which we operate, and that would be outside of our traditional role.
Got you. Well, when you have challenging times, it takes challenging solutions. Sometimes we may need to see, you guys step outside of your normal role and make some changes, because there are a lot of people in trouble right now, and it's affecting the overall economy. I'm going to talk to you more about it after the break. When we come back from the break, we'll give some solutions to folks out there, and if you are in trouble with your mortgage, if you haven't been able to refinance or work something out with the lender, when we come back from the break, we're going to offer you some solutions. Stay with us here on Money Morning. My name's Eric Stewart.
And I'm Paul Robinson.
We'll be right back.